Fiscal stress, AI-driven earnings, and a flight to hard assets are pulling major asset classes in very different directions right now. Welcome to vTalkInsight / Allocator's Lens Daily for August 26, 2026. Cross-asset correlations are shifting as long-term yields climb. Equity leadership narrows around artificial intelligence, and gold and Bitcoin respond to growing policy uncertainty. So the interaction between rates, risk assets, and commodities really matters today. Let's start with equities. In equities, the core tension is between a powerful AI-driven earnings story and a steadily more demanding macro backdrop from rates and the consumer. The AI narrative is still the dominant force for equity sentiment, often outweighing traditional macro drivers like Federal Reserve policy or incoming data. Record capital expenditure on AI infrastructure is seen as fueling an unusually strong earnings cycle, with some expecting an unprecedented contribution from just a handful of mega-cap names. NVIDIA sits at the center of that story, and its upcoming earnings are treated almost like a macro event. The company is expected to deliver revenue growth above 90% with strong margins, and many forecasts see sales well north of $90 billion, underlining extraordinary demand for AI hardware. Yet the stock has just endured its longest losing streak since 2022. Its forward multiple has fallen from around 60 times to roughly market-like levels near 18 times, and credit default swaps have doubled, showing that investors are questioning how much future growth is already embedded in the price. More broadly across tech, recent corrections in semiconductors, software, and hardware have helped bring valuations back toward levels that better match even strong earnings growth. However, we are also seeing the limits of the story. Companies like Intuit have missed guidance and sold off sharply, highlighting that not all software names can pass higher funding and wage costs through profits. At the index level, the S&P 500 is trading around 20 times forward earnings and remains range-bound, even after strong beats from many companies. One concern is that roughly a third of expected earnings growth for 2026 is projected to come from just NVIDIA and Micron, creating concentration risk even as index weightings have diversified somewhat. Under the surface, the consumer picture is turning less friendly for cyclicals and growth stories that rely on volume. Consumer confidence expectations have dropped sharply. New home sales are down more than 10% month-on-month as higher mortgage rates bite, and personal consumption growth is only around 2%, with upcoming PCE data expected to show stagnant incomes and sticky core inflation above the Federal Reserve's target. Household equity allocations are at record highs while cash relative to market capitalization is near record lows, so positioning looks stretched just as a seasonally choppy period begins, encouraging talk of large cap value as a relative defensive area rather than an all-out risk-off move. Higher long-term yields are a key part of this equity story. 10-year treasuries already trade well above 4.5%, and there is open discussion about yields moving toward 5%, which would further raise the discount rate on long-dated tech and AI cash flows and push up capex funding costs. So far, equities have been surprisingly resilient to that pressure, with volatility gauges like the VIX sitting in the mid-teens and indices grinding sideways rather than breaking down. European equities are quietly outperforming expectations on solid earnings and consumer strength, and UK large caps are viewed as attractively valued with more realistic fiscal debates, adding a geographic diversification angle. For allocators, the next catalysts are clear. NVIDIA's earnings and guidance, US PCE inflation, and messaging from Jackson Hole will help determine whether equities can keep leaning on AI strength or whether the bond market finally forces a broader derating. Turning to rates, the long end of the Treasury curve remains the main macro pressure point. Rising yields are increasingly being explained not by a surge in inflation expectations, but by a higher term premium as investors demand more compensation for holding U.S. debt in the face of persistent large deficits and heavy issuance. 10-year yields around 4.75% are seen as a discomfort threshold for policymakers, with anxiety building as levels approach 5%. And some argue that current yields are still accommodative given robust nominal GDP growth. The fiscal story is central. There's a growing sense that U.S. deficits will only be addressed when bond market conditions become unambiguously painful, for example through failed auctions or a disorderly spike in yields that creates visible political costs. Against that backdrop, Recent Treasury buybacks and draws on the Treasury General account are widely viewed as short-term cosmetics rather than a structural fix. They do little to change the underlying supply of duration, and some prominent investors describe these actions as market manipulation that undermines price discovery and could ultimately weaken confidence in both the Treasury market and the dollar. Monetary policy adds another layer of uncertainty. Markets are toying with the idea of as many as 3 additional Federal Reserve hikes starting as soon as September, reflecting expectations that real growth will stay above trend and inflation will remain stuck above 3%. Several FOMC members have signaled they would be inclined to raise rates again if inflation re-accelerates, especially if oil hovers near $90 and keeps headline prints elevated. At the same time, the Fed has backed away from detailed forward guidance, which is injecting volatility into both rates and equities as traders guess which variables really drive the reaction function. The interaction between fiscal and monetary authorities is becoming more fraught. Treasury actions to lean against rising yields can run at cross purposes with the Fed's efforts to keep financial conditions sufficiently tight, leading some to talk about a de facto policy divergence inside the U.S. state. Speculation about a new accord that would more closely align debt management with the Fed's balance sheet has contributed to a weaker dollar and a strong rally in gold, reinforcing fears of financial repression and currency debasement, even as long-term inflation expectations remain anchored. For allocators, the key rate questions now revolve around how high term premia can go and what would cap them. Some investors see 5% on the 10-year and 6% on the 30-year as levels that would attract substantial long-term demand, potentially stabilizing the curve. Others argue that only a very clear, credible commitment from the Fed to returning core PCE inflation to 2% would materially compress the risk premium embedded in long-dated yields. The upcoming PCE release and the Fed chair's speech at Jackson Hole may not settle the debate, but they will signal whether policymakers are willing to tolerate the bond market imposing fiscal discipline, or whether they try harder to contain yields and accept the currency implications. Credit still looks benign on the surface, but the details tell a more complicated story. Spreads remain extremely tight, with much of the high-yield universe actually trading through headline indices, and the overall fixed income environment offers attractive all-in yields without needing to extend too far out the curve. Data center and chip infrastructure have been a major source of new supply, with tens of billions of dollars issued in the private placement market and strong demand for exposure to digital infrastructure debt. Within that calm backdrop, a two-tier structure is emerging. AI and tech hyperscalers are tapping bond markets heavily to fund data center build-outs, diversifying across currencies and investor bases. They are paying somewhat higher spreads, not because of immediate credit quality concerns, but because investors anticipate a heavy pipeline of further issuance. At the same time, credit risk is clearly rising in parts of the AI ecosystem. Credit default swaps have widened for certain firms, and there are worries about circular financing structures that depend on continued market enthusiasm for AI-related projects. Private credit and private equity are also showing late-cycle characteristics. Years of elevated purchase multiples and now higher financing costs have left private equity portfolios with aging assets that are hard to exit at book values, pushing sponsors towards structured equity and other creative liquidity tools to return capital. In software and tech-related private lending, the balance of power has swung decisively toward lenders, who can now demand higher coupons, tighter covenants, and more frequent monitoring, particularly where AI threatens incumbent business models. The hedge fund community offers another clue. A major fund's assets have reportedly fallen from over $40 billion to about $10 billion, with knock-on effects across other managers due to common exposures and leverage in popular tech and AI trades. Regulators have responded with subpoenas to large banks for detailed information on hedge fund trading, signaling more scrutiny of leverage and liquidity risk. Put together, credit markets still price in very little near-term default risk, but hidden leverage, off-balance sheet financing, and concentration in AI-related exposures mean that the cushion against a macro or rate shock is thinner than spreads alone would suggest. Foreign exchange is increasingly where policy tensions show up most clearly. On one side, the dollar still behaves like a traditional safe haven when geopolitical risks flare. Recent U.S. moves to tighten financial sanctions on Iran, for example, have supported the currency and reminded markets of its central role in the global system. On the other side, persistent talk of aggressive fiscal and monetary interventions, including speculation about a new Treasury-Fed accord, has fueled fears of financial repression and long-term debasement, contributing to episodes of dollar weakness even with high U.S. real yields. There are also signals that some U.S. policymakers would not mind a somewhat weaker dollar. The currency is often described as overvalued on long-term fundamentals, and nudging it lower is seen as less risky than directly suppressing Treasury yields, especially if it helps relieve pressure on the yen and euro. At the same time, using the dollar as a geopolitical tool continues to accelerate gradual de-dollarization, with reserve managers and sovereign investors diversifying at the margin into other currencies and real assets. The clearest expressions of these tensions are in gold and crypto. Gold is enjoying its strongest monthly rally since the late 1990s, helped by geopolitical uncertainty and concerns over fiscal sustainability, even though long-term inflation expectations remain well anchored. Bitcoin has broken above its 200-day moving average with convincing follow-through, a classic technical signal of a potential new uptrend, and is increasingly discussed as part of a basket of debasement hedges. Regionally, higher natural gas prices are weighing on the euro despite earlier periods when stronger gas prices went hand-in-hand with a firmer currency, and Canada finds itself balancing trade tensions with the U.S. against its growing role as a major holder of treasuries. Overall, FX and digital assets are acting as a barometer of how the world judges U.S. policy credibility. Finally, commodities, and especially energy, are keeping the inflation debate alive. Global oil inventories have fallen by close to 2 billion barrels over time, reflecting persistent supply disruptions from the Middle East, while diesel markets are acutely tight due to Russian refinery outages, reduced Chinese exports, and broader refining bottlenecks. Refining margins for diesel and heating oil are historically elevated relative to crude, underscoring how tight the product market has become. Geopolitics around the Strait of Hormuz add another risk layer. U.S. pressure on Iran focuses attention on a key choke point for oil flows, even as Gulf producers and international oil companies invest heavily in new pipelines, storage, and alternative ports to reduce reliance on that route and limit Iran's leverage. Major integrated oil firms have managed to offset some operational disruptions with strong refining and trading results, but shipping routes remain vulnerable to further shocks. Natural gas is part of the same story, particularly for Europe. Storage levels are lower than last year, and prices are already up roughly 30% from recent lows, which has started to weigh on the euro and raises the stakes for the coming winter. China's policy-driven efforts to curb gasoline and diesel use, along with weaker population growth, are tempering global demand at the margin and have had an effect on balances similar to Western Reserve releases. The macro link is straightforward. If oil remains near $90 and gas stays tight, the odds rise that inflation re-accelerates, keeping pressure on central banks, supporting long-term yields, and feeding back into the cross-asset picture we had discussed across equities, rates, credit, and FX. Across assets, the message is that nothing is moving in isolation. Equities are still leaning on AI-driven earnings and capital expenditure, but with stretched positioning and growing sensitivity to consumers and funding costs as long-dated yields grind higher. The rates market is demanding a fiscal risk premium and testing how far policymakers will let term premia rise, while credit spreads stay tight even as leverage, private structures, and AI funding needs build hidden fragility. In FX and alternatives, the dollar, gold, and Bitcoin are expressing the world's judgment on U.S. policy credibility, and tight oil and gas markets are the bridge back to inflation and the bond market. For allocators, the key watch points now are long end U.S. yield around the 5% line, NVIDIA's earnings, and AI capital expenditure guidance, USPC, inflation, and Jackson Hole communication, and the resilience of the recent rush into hard asset hedges. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.